On today's Hashi, I'm discussing what the bond sell-off means for the economy's soft landing, the amount of stress home buyers are feeling, and active mortgages. Today is Thursday, October 5th, 2023. I'm Byron Lazine, and the hot sheet starts now. Welcome to the Hashi, and thanks for tuning in. If you're here on the live chat, let me know which market you're tuning in from. I'm here in the Connecticut studio, and tomorrow I'll be doing Free Format Friday from my Naples studio. We've got a couple of new wrinkles for Free Format Friday. Been working on it here over the last week or so. A couple of guest spots. We've got the call-in number, and then your questions as well. Any breaking news, of course, we'll talk about that as well. So make sure you subscribe to the channel so you don't miss Free Format Friday tomorrow. And of course, get the most out of all of our content here at BAM by using the code HOT down below to sign up for BAMX. You get 10% off of your subscription, and you won't miss things like you missed yesterday, the first ever YouTube accountability group. You won't miss out on any of the downloads from this show each and every single day, and access to everything that we're doing in our group. So join BAMX today by using code HOT down below. What continues to be the hottest of hot is the 10-year Treasury note. It actually peaked this week up over 4.8, which is like almost unthinkable. Remember, the average since 1790 is actually 4.5. Every time we get up over 4.5, we stay higher for longer. And so why is this important? Why is the increase on this 10-year and really just any long-term interest rates being higher? Why is that not only important to us? Well, we know besides the 30-year fixed, it's really important because it's pushing up that 30-year fixed quite a bit. But it's also now into the 7.7 plus range. We're living in 7.75 or 8 in some instances range. But it also decreases the chances of a soft landing. Let me explain, and then I have a chart from Nick Tiramos from Wall Street Journal. The Federal Reserve obviously has been increasing the short-term rates for over years, pushed up long-term bond yields, okay? But recently, those long-term bond yields have been rapidly increasing, and this is causing concerns, especially as inflation has eased. And the Fed has indicated it's close to finishing maybe even its rate hikes, but yet this 10-year just keeps going up. It's the highest level since the subprime mortgage crisis of 2007. Okay, it's actually even touched the peak there. The surge in rates has led to a decline in stock prices and major indices like Dow Jones or Dow Industrials and the S&P 500. Okay, so why is that happening? Why does the 10-year get the stock market to go down? Well, if you've got money, we're talking investors that can move the market, millions and millions and millions of dollars to put into the market. Well, if I can get close to 5% on my money, why at that point, why would I take a risk for 7 or 8% in the stock market for, basically what many consider a guarantee on the 10-year? When the 10-year was at 0 or at 1 or 2, I think I'll go take my chances in a stock market. And what did you see there when people are moving the money in the stock market? You see an acceleration of those stock prices, of those, equities. Now people are taking their money out, and that's going to reduce the stock market. Stock market going down potentially will not only impact investors, but it could impact businesses, people who are moving money around, that are hiring people, maybe hiring less. This is something you got to factor in down the road. Hasn't happened yet. Job market's been very strong, but could have an impact on the overall economy. All right. Going back to this Wall Street Journal piece, the main factors contributing to higher rates, expectations of improved U.S. economic growth and concerns over the large federal deficits, which may limit investors' capacity to absorb more government debt. Okay, the lack of clear explanation for the rate increase suggests that the term premium, the extra yield investors demand for holding longer term dated assets, is rising. potentially lending to higher borrowing costs for the government. Okay, so the government, in order to sell or basically get sell these bonds and handle our debt obligations. This number now is going to continue to go up. Okay, and in terms of what they've got to keep asking, so this will keep pushing the interest rates up, and there's really no sign of it going down right now. Okay, so that's one of the issues with another one of the issues with this 10-year continuing to go up. And um, here's the yield on the 10-year Treasury note from the Wall Street Journal. Of course, this can lead to a hard landing, and that's what we're fearing right now. All right, let's go back to what Nick Tiramos says. Why is it important from Nick Tiramos? Because he kind of sees things before they're coming. In fact, I made the case yesterday. A lot of times, if you want to know what Jay Powell, as he calls himself now on IG and Threads, is thinking, you just go to Nick T's Instagram, or not his Instagram. I don't think he's on Instagram, but on his Twitter X. Okay, like I'm going to do right now, because on Twitter X, he'll show you things before they happen. And he's showing this interesting chart, which I'll put in the download for BAMX. Normally at the end of Fed tightening cycles, bonds will rally. So he's actually showing us what the market has done. This is something in housing we need to be cognizant of ourselves. I don't know what the market's going to do, but I know what it has done. Normally at the end of Fed tightening cycles, bonds rally. This time has been different. Investors had priced in and are now pricing out a recession with a quick turn towards rate cuts. Okay, so you can see here the basically reversal of what's happened in 95 and 2000 and 2018 and 2006 during this case of what's happening right now in 2023. Okay, so this is the link here to the Wall Street Journal article that I was referencing. So there you go from Nick T. Now moving into some of the struggles that are happening because of these high rates for home buyers. 59% of recent home buyers say purchasing a house is actually more stressful than dating. Well, it depends on who you're dating, I guess. Baby boomers are most likely to say the opposite, with nearly half saying dating is more stressful than home buying. Baby boomer, a lot of them been together for a long time, so dating probably would freak out many boomers. Divorce and finding a new job were only two listed life events that a majority of respondents said are the more stressful than purchasing a home. And so let's dig into some more of this data here from Redfin. Share of recent home buyers who said buying a home is more stressful than 66% buying a car. So 66% say buying a home more stressful than buying a car, and it should be. I bought a Tesla on a freaking phone. I mean, it was easy. It was actually not stressful at all. In fact, it was like going and pouring a glass of water from the faucet. It was the easiest thing in the world. Share of home buyers said buying a home is more stressful than potty training a child, 61%. I don't know. That is a hard job. That's a really hard job. Dating, 59%. Getting into college, 58%. Yeah, I would say buying a home is more stressful than getting into college because anybody can get in. They'll throw money at you no matter what your qualifications are. Planning a wedding, 51%. Finding a new job, 44%. Getting a divorce, 43%. So interesting. Listen, home buying is stressful. That's why there are great professionals that exist today. And it's why there's going to be great professionals that exist far into the future. Okay. Because when you're great at your job, you're going to absorb some of that stress. I often tell agents, hey, your job's not to be emotional. They're going to be this is one of the top 3 stressful moments. Your job is to absorb the stress because you're high on the knowledge of the market, of what's going on, how to put together a deal so that you can absorb that stress because you're giving quality advice. You're giving good, stern information that hits. So you can put your head on the pillow. You can absorb that stress and let it pass through you. You don't have to muster in it, because when you know what you're doing, the stress is less. Now, sales professionals that are here on the hot sheet, I want you to listen closely. I want you to listen real closely, sales professionals. People are looking for a stress-free life. You'll be stress-free when you're dead. Okay. So if you're looking for a stress-free life, you're hoping to die. You're not going to have a stress-free. This is called life. There's going to be a level of stress. And I think everybody here, if you're a Bammer, you get with that, because you're a high standard professional who's hungry, who wants it. So I think you understand that, right? And that's just the reality of the world. Millennials and Gen X, they're most likely to think home buying is more stressful than dating. Baby boomers are most likely to think the opposite. So millennials and Gen Xers are the most likely group to emphasize the anxieties of home buying, with nearly 2/3 saying it's more stressful than dating. And for them, they're more impacted by the interest rate. So I get it. I feel that. Baby boomers and Gen Zers were most likely to say dating is more stressful. Baby boomers recently overtook millennials as the largest home buying generation this year, in large part because they've spent years building home equity, making it easier for them to transact. We've been mentioning this a lot, where it's like, hey, who's least impacted by the interest rates? Definitely boomers. Older generations were most likely to emphasize the stress of divorce. 67% of boomers said divorce is more stressful than home buying, compared with 61% of millennials. 48% of Gen Z respondents. Baby boomers are more likely to have experienced divorce, obviously, than, say, Gen Z. They haven't even gotten married yet, simply because they're older. All right, great insight, Redfin. Way to go. Way to go there. Way to go on your ousting of NAR, which, when you dig deeper on that, we've got a story on nowbam.com that you can check out. But when you dig deeper on that, a lot of the agents can't even get out because their state has the tie-in agreement. So good luck there. Thanks, Redfin, for the updates. All right. Now moving into the mortgage side of the equation. Obviously, we know buying a home is stressful. One of the reasons why is the higher mortgage rates. This has been the story in 2023. And guess what? Get used to it. It's 2024 story as well. Okay. It's going to impact the market. Mortgages originated over the last 18 months, evenly distributed across rate bonds ranging from the mid-3 range up through the high 6s, meaning that rate term refinance volumes would return gradually should those rates improve, because you got now mortgages at different rates. Relatively few loans, less than 600,000 of August month end, have interest rate at 7% of above, but that number is increasing. Take a look at this. Okay, just 1 year ago, the beginning of this year, only 8% of outstanding mortgage debt was higher than 5%. In fact, 90% of mortgage debt had a interest rate of 5% or below, actually below 5%. Well, today, that number is only 82.3 to be exact. 82.4% of people are under a 5% mortgage. Okay. And then you look at the 4 to 5% today, it's 15.6, and 4% or less, it's only 67%, where it was 3 out of 4 loans, it was 76.4%. So because of the loans that have worked through the system at higher rates today, you're starting to see the number shift again. Remember, real estate's cyclical. Things change, they ebb and they flow. We're going to stack up, a number of transactions. Even if at 4 million transactions, seasonally adjusted 12-month run, even at about 70% of those, you're going to be just under 3 million are holding a mortgage. If you're going to have 35% on cash. Lance Lambert, our buddy over at Fortune, the number of active loans by mortgage rate, he put up this chart as tracked by Black Knight. Okay, so here you go. You can see that there are very few loans, relatively speaking, right now above 7%. But that number, every single month that goes by, is going to continue to get bigger and bigger, which will open up movement in the market. Look at how many, though, are sitting at that 3 and just under 3. Those 5 million active mortgages that are at the 3%, those are the folks that are probably a little bit locked in. But that range from 5.5 to say 4%, there's a lot of mortgages right there. Okay. You've got a lot of folks, and especially 2000 and 10 to 14 era that are in that range. Certainly 2018, 2019 loans and 18 loans. 18, the interest rates started popping up a little bit. They're good folks to have a conversation with. They might be more apt to move. Okay. So while the number is seems kind of big right now, it is growing in the other direction just because we are sitting in the higher rates for longer, and that doesn't seem to go away. Mortgage delinquencies decreased slightly in August, but we have seen signals here recently of a little bit of an uptick, and we think we're finding potentially the bottom. But these mortgage holders, you say, well, they're going up into that 7 and 8% slowly right now because that's where we've been sitting. Maybe you're going to see delinquencies. Well, they actually dropped slightly in August. We may be finding a bottom, but when you look here, you're still well below the 2000 to 2005 average. So even bouncing up to that would be, just hitting the average. We have no signs of a problem there. All right. There's your update. We've got a 30-year, obviously, going into tomorrow's free format Friday. That ended the day yesterday at 7.70 from 7.72 the day before. Continue to monitor that into the weekend. I don't expect much change there, but looking forward. Make sure you're subscribed to the channel. Looking forward to free format Friday, where we've got a couple of guest spots. We've got our phone number open so you can have a live call with me and a few surprise others maybe tomorrow, as well as your questions from the week. It's free format Friday. I'll also break any news that happens tomorrow morning. Subscribe to the channel so you don't miss it. Love to see you in BAMX. Use code HOT to get 10% off of that so you don't miss what we're doing in that community. And until tomorrow, free format Friday, have a great day and toodaloo.